Pull up your screen right now. Gold is trading at 5,075. Silver is sitting at $85.51. You just watched that silver price move in a direction the mainstream financial media is about to spend the rest of the afternoon explaining to you in the most misleading way imaginable. They will blame the CPI report. They will discuss Federal Reserve expectations. They will frame a $4 paper price decline as proof that the silver bull market is losing momentum and that smart investors are rotating out. They will say it confidently. They will say it while pointing at charts. And every word of that explanation will be designed to create one specific reaction in your mind. I want to stop you before that reaction takes over. Because while that narrative is being assembled for public consumption, something happened today inside the research department of the largest asset manager in the history of global capital markets that tells an entirely different story about this metal and about what today's drop actually means. Christia Coulian, the head of iShares investment strategy for the Americas at BlackRock, released an institutional strategy memo today. The same day the CPI data printed and the paper price was hammered lower, she published a report that was not written for the public. It was written for clients managing capital on a scale where a single portfolio decision can redirect billions of dollars. And that memo does not say what you are hearing on television right now. It says the exact opposite. It confirms that the structural argument for precious metals is not weakening. It is strengthening. And it confirms that the price you see on your screen today does not accurately represent the reality the world's most sophisticated capital allocators are quietly positioning for, with patience, precision, and growing urgency. There is a gap forming. And that gap may be the most important data point you encounter today. Not the CPI print, not the open interest figures. The gap between the paper price of silver and what BlackRock is privately telling its wealthiest institutional clients about where this market is heading. I am going to show you exactly how wide that gap is becoming. I am going to show you the hidden systemic risk forming underneath the CPI narrative that almost nobody is discussing. And I am going to show you mechanical evidence proving that the physical silver market is already signaling something very different from the paper market. By the time this video ends, you will understand why today's drop was not a warning sign. It was a window. And that window will not remain open forever. Here is the structure of what happened today, and I want you to see it clearly because once you understand it, the confusion disappears completely. The mainstream financial media is constructing a story around the CPI release. Their narrative says inflation data increases uncertainty around Federal Reserve policy. Fed uncertainty is negative for metals. Therefore, the drop in silver is a logical market reaction. That story sounds coherent. It feels internally consistent. It will be delivered by credentialed analysts inside professional studios. And it will produce exactly one outcome among retail investors who accept it. The belief that selling is the sensible response to today's price movement. At the same time, through a completely different communication channel that never appears on television, BlackRock is telling institutional clients that precious metals represent the ultimate portfolio stabilizer in the current macroeconomic environment. Same market, same day. Two messages traveling in opposite directions to two entirely different audiences. The public receives fear. Institutions receive a buying framework. Because fear in retail investors creates the opportunity institutions need to accumulate assets at lower prices. That is the architecture of the system. That is how it operates. Before we examine the BlackRock memo in detail, a quick note. I read institutional research. I follow physical market data. And I translate what I find into plain language for people who are not invited into the client meetings where this information is normally shared. Nothing in this video is financial advice. What I present is the same data institutions review, stripped of the technical language that normally keeps it inaccessible to everyday investors. But before we walk through the catalysts in the memo, let me ask you a direct question. When silver printed $85.50 today and the news cycle began constructing its CPI explanation for the drop, what was your immediate reaction? Did you see it as a genuine warning sign for the metal? Or did you recognize it immediately as a manufactured event and begin thinking about what it means for your positioning going forward? Leave your honest answer in the comments right now. Your response reveals whether your mental framework for this market is built around the paper pricing mechanism or around the structural forces that actually determine long-term value. Knowing which framework you operate within is one of the most important forms of self-awareness you can have in a market environment like this. Now let's talk about what the BlackRock memo actually says. Not the shortened media summary, not the 3-sentence wire interpretation, The full substance. Christia Koulian published a comprehensive institutional analysis examining precious metals as a portfolio construction tool in the current macroeconomic environment. Silver surged 148% during 2025. Gold climbed 75% over the past year, crossing $5,000 per ounce in January before pulling back about 12% by month's end. Silver volatility has jumped 106% year to date. Gold volatility is up 46%. Koulian described the market using one word: powerful. She described the risk environment using another word: real. That was the framing given to billion-dollar clients before presenting the three structural catalysts driving the analysis. Not panic, not a top signal. The memo identifies three forces making it mathematically implausible for the precious metals market to behave the way the paper price currently suggests. Three catalysts, each more significant than the last, and none of them are technical indicators, seasonal factors, or CPI-dependent narratives. They are structural, they are long-duration forces, and they are accelerating. The first catalyst is something most people conceptually understand but struggle to accept at its current scale. The United States federal government now carries debt exceeding 120% of GDP. At the same time, annual deficits are running between 6 and 7% of GDP. And this is not uniquely an American problem. Japan, the United Kingdom, France, Canada. Debt saturation is systemic across developed economies. Here is what that means operationally. An increasing share of government borrowing is no longer funding new programs or infrastructure. It is funding interest payments on existing debt. Governments are issuing new debt simply to service old debt. That is the mechanical definition of a sovereign debt spiral. And once that spiral reaches the scale confirmed in the memo, the available resolutions narrow to three possibilities: default, restructuring, or currency devaluation. Democratic governments that control global reserve currencies rarely default openly. Instead, they devalue gradually, then rapidly. Historically, gold has performed strongly in these environments. Silver often behaves as a higher beta extension of the same trend. When the store of value case strengthens at the sovereign level, silver tends to amplify the move. But debt alone does not explain why silver specifically matters now. The second catalyst is what makes this cycle different from previous metal cycles. Central banks hold roughly 20% of all gold ever mined, and they have been steadily increasing those holdings. The memo confirms that central banks expanded reserves from 2022 through 2025 specifically to diversify away from the US dollar. Then comes the detail that barely registered in mainstream headlines. In 2025, gold surpassed US Treasuries as the largest share of global reserves for the first time in 3 decades. Read that again. The asset sovereign monetary institutions now trust more than US government debt is gold, and the buying momentum is accelerating. The final catalyst involves industrial demand. Nearly 60% of annual silver consumption is tied to electronics, solar technology, and semiconductors. Electronics alone require roughly 445 million ounces per year. Solar photovoltaic demand accounted for nearly 29% of industrial consumption in 2024, compared with about 11% in 2014. That is nearly a threefold increase in a single decade, driven by global electrification policies. There is no synthetic material that replicates silver's conductivity at comparable cost, which means the technological future being built right now depends heavily on a metal whose supply is finite. When BlackRock presents these dynamics to clients managing billion-dollar portfolios, the conclusion becomes unavoidable. Industrial demand is structurally rising while supply remains limited. The price on your screen today has not yet reflected the demand curve already forming, and that realization changes how you interpret today's drop entirely. Today was not the end of a trend. Today was the setup.